Welcome to the Pro Ticker Deep Dive. We're looking at a date that is almost certainly going down in the financial history books.
Yeah, March 4, 2026.
Exactly. And we're starting today with a massive, almost unbelievable paradox that's just unfolding right this second across the global markets.
It is wild.
It really is. Okay, let's unpack this for you. So Bitcoin has just surged past $72,000. It is wildly outperforming major altcoins. The momentum feels absolutely electric. And I mean, if you're just a casual observer looking at the surface level price action on your phone, you'd think we're off to the races.
Right, you'd think it's a clear breakout.
But here's the catch, and it's a huge one. If you actually look at the prediction markets, platforms like Polymarket, where sophisticated, deeply capitalized money places hard bets on future outcomes, they're currently assigning a massive 62% probability that Bitcoin is going to crash down to $50,000 this year.
A 62% chance of a catastrophic drop.
Right in the middle of a rally. How does that make sense? How can the price be surging, yet the smart money is betting heavily on a collapse?
It's a fascinating contradiction, honestly, and frankly, it's exactly why we're digging into this today. To understand this paradox, we have a very specific mission for this deep dive.
Let's lay it out.
We're going to unpack 4 key areas that are driving this massive divergence, and none of them exist in a vacuum. First, we have to look at the severe geopolitical stress test happening right now in the Middle East, and how it's brutally exposing digital assets as high beta risk investments rather than traditional safe havens.
Which totally flips the script.
Exactly.
Yeah.
Second, we're going to pivot to Washington, D.C., specifically looking at the legislative gridlock that's currently holding back literally trillions of dollars in institutional capital.
The regulatory turf war.
Yep. Third, we are tracking the hidden massive whale accumulation happening quietly right under the retail market's nose. And finally, we'll give you a masterclass in the technical indicators that show exactly why a crash to 50,000 and a massive rally to 170,000 are both mathematically on the table right now.
So what does this all mean for you listening right now? Whether you're a seasoned investor managing a complex portfolio, a tech enthusiast watching the blockchain space evolve, or honestly just someone trying to protect your hard-earned savings from having its purchasing power melted away by inflation, this matters.
It matters heavily.
Because the mechanics driving this current market divergence aren't just crypto-specific. They are the literal gears shifting in the broader global economy. If you understand what's happening under the hood of Bitcoin right now, you understand the macro forces shaping the rest of the decade.
Perfectly said. And to really grasp the magnitude of what's happening, we have to start with the most immediate kinetic catalyst shaking the global markets today.
The Middle East.
Right. We're looking at a severe escalating situation in the region. Recently, we've seen military strikes by the United States and Israel directed at Iranian security infrastructure.
And then the retaliation.
Exactly. We've seen retaliatory Iranian attacks on U.S. sites located in Dubai and Qatar. Now, we have to look at this strictly through an economic lens for a moment. This isn't just political posturing. This is kinetic conflict that has immediate, profound implications for global supply chains, energy markets, and consequently, the price of every single asset in your portfolio.
Right, because whenever you have global instability of this magnitude, you look to see how the markets react in real time. You look for who hits the panic button, and you look for where the money runs to hide.
The flight to safety.
Exactly. And the immediate reaction from traditional finance was incredibly textbook. I mean, traditional safe havens acted exactly the way they have for centuries. Gold surged 1.8% almost instantly to hit absolute record highs of $5,400 an ounce.
Massive move for gold.
Huge. And silver climbed over 5%, breaking through that key $91 psychological level before experiencing some extreme volatility that saw it collapse back below $84. But the metals did their job, didn't they? They absorbed the panic.
They absolutely did. But what's fascinating here is the massive asset class divergence we witnessed with Bitcoin during that exact same window.
Right, the digital gold narrative.
Yeah, for years, the prevailing narrative, the core marketing pitch to institutional investors, essentially has been that Bitcoin is digital gold. The theory was that in times of geopolitical crisis, it would act as a non-sovereign, censorship-resistant safe haven.
But it didn't.
Its reaction to this specific geopolitical shock was chaotic, to say the least. Initially, as the news of the military strikes broke and the uncertainty peaked, Bitcoin collapsed towards $63,000.
It tanked.
It behaved exactly like a risk asset being dumped in a panic by major funds trying to raise cash. But then, it executed this incredibly violent, volatile short squeeze, recovering all the way back up to the $71,000 to $73,000 range.
Wait, hold on. So it dumped when people were terrified and then squeezed back up on pure market mechanics.
Yep.
That entirely breaks the digital gold narrative, doesn't it? I mean, if I'm an investor seeking a safe haven, I don't want a violent collapse followed by a volatile short squeeze. I want stability. I want a rock.
Precisely. If we connect this to the bigger picture, the reality the market is pricing in right now is that crypto is currently acting as a high beta risk asset.
Yeah.
It is behaving much more like a speculative, high-growth technology stock than it is like gold.
Okay, let's pause there because we throw around terms like high beta a lot in finance. For you listening, when we say high beta, think of it like a trampoline compared to solid ground.
I like that analogy.
Yeah, so if the S&P 500 or the Nasdaq, the broad market jumps a foot, a high beta asset like Bitcoin gets launched 10 feet in the air. It amplifies the market's movements. But the dangerous part is the way down. If the broader market drops, that high beta asset crashes straight through the floor. It's pure amplification of risk.
That's a great way to visualize it. And to understand why it's acting like that trampoline right now, we have to trace the economic transmission mechanism of this Middle Eastern conflict. The attacks in the region have led to the effective closure of the Strait of Hormuz.
Which is massive.
It is one of the most critical global maritime choke points on the planet. That closure immediately pushed Brent crude oil into the $80 range.
Let me jump in here with another analogy because this transmission mechanism from oil to Bitcoin is crucial for you to understand, especially if you're trying to figure out why a war halfway across the world affects your digital wallet.
Go for it.
Imagine the global economy as a giant engine, and oil is the temperature gauge. When the Strait of Hormuz closes, it's like someone blocking the radiator. The engine immediately starts running hot.
And that heat is inflation.
Exactly. And when inflation runs hot, the Federal Reserve, the mechanic in this scenario, has to act.
Right. Oil shocks feed directly and aggressively into inflation expectations. When the bond market expects higher inflation, it expects the Federal Reserve to keep interest rates higher for a much longer period to combat that inflation.
Because they can't let it run out of control.
Exactly. Higher interest rates make the U.S. dollar incredibly attractive to yield-seeking investors globally. As a result of this exact chain of events, we saw the DXY, the U.S. dollar index, which measures the dollar against a basket of foreign currencies, hit a 5-week high of 99.4.
And here is the golden rule of modern finance for you to remember. A strong, yield-bearing dollar absolutely crushes non-yielding risk assets. That includes your high-growth tech stocks, and right now, that emphatically includes Bitcoin.
You got it. And we need to look at the doomsday oil math here, because the numbers coming out of the Gulf right now are staggering. Daily crude flow through the Strait of Hormuz has dropped from a normal, healthy flow of 16 million barrels a day to just 4 million.
Wait, that's a 12 million barrel daily deficit?
It is.
In a global market that relies entirely on just-in-time delivery, that's catastrophic.
And what about the reserves? I mean, surely these countries have stockpiles to weather a short-term closure, right?
They do, but it's much thinner than the market assumed. The Gulf states currently only have a 25-day inventory buffer.
Wow, 25 days.
We are quite literally on a ticking clock. Those numbers are critical because they allow quantitative analysts to model the Consumer Price Index, or CPI, scenarios. This is an abstract theory. This directly impacts when or if the Fed cuts rates, which dictates global liquidity.
Let's break those models down. What happens if oil prices keep creeping up? Well, if oil pushes into the $115 to $130 range, the models show the CPI increasing by 110 to 150 basis points.
To put that in everyday terms for you listening, a basis point is 0.01%. So an increase of 150 basis points means inflation goes up by 1.5%.
Which is massive.
It really is. It might not sound like a lot on paper, but when the Fed's target is 2%, a sudden 1.5% jump is an absolute earthquake.
Is an earthquake.
Yeah.
If that happens, you can entirely forget about Fed rate cuts in 2026. The market is currently pricing them in, but an oil shock of that magnitude will push any monetary easing out to 2027 at the earliest.
Okay, but what's the worst-case scenario? What if the conflict broadens, the strait remains closed, and oil breaks $180 a barrel?
If oil exceeds $180, the math gets incredibly dark. The CPI would rise by over 300 basis points.
A massive 3% spike.
Exactly. That doesn't just delay rate cuts, that triggers structural stagflation. That is the nightmare scenario of high inflation coupled with severe economic stagnation and rising unemployment. This raises an important question for investors. What specific indicators should you be watching on your screens to front-run this?
That's the million-dollar question. And for you listening, here is your major actionable takeaway for this section. Watch the 10-year TPS real interest rate.
Crucial metric.
Yeah, TPS stands for Treasury Inflation-Protected Securities. If that real yield breaks above 2.5%, it signals that the smartest money in the bond market is bracing for severe, persistent inflation and an aggressively hawkish Fed. That could trigger a massive, brutal sell-off in tech stocks.
And here's where the paradox deepens. A severe tech stock sell-off might be exactly what Bitcoin needs in the long run.
Wait, how does that make sense? We just established Bitcoin acts like a high-beta tech stock. If tech crashes, shouldn't Bitcoin crash harder?
In the short term, yes. But if tech equities collapse due to high real yields and Bitcoin initially drops, but then manages to find a floor and hold its ground while the Nasdaq continues to bleed,
Then the correlation breaks.
exactly. It might finally break its historical correlation with equities. That decoupling is the holy grail. That is the exact moment it could truly begin to act as the non-sovereign digital gold the market has been waiting for. But until that correlation breaks, it remains a high beta hostage to oil, inflation, and the strength of the dollar.
Okay, so we have the geopolitical fire burning on one side of the world, acting as a massive ceiling on the price globally. Let's transition to the domestic front. Because while the Middle East is dictating the macro inflation narrative, Washington, D.C. is dictating the structural, legal future of the asset class.
And right now it's a mess.
It really is. For years, we've watched this endless, grinding bureaucratic tug-of-war between the SEC, the Securities and Exchange Commission, and the CFTC, the Commodity Futures Trading Commission. They have been fighting tooth and nail over who gets to regulate the crypto industry.
It has been a jurisdictional nightmare. And it's not just inside baseball for lawyers. This regulatory ambiguity has actively kept traditional institutional capital swaller. The pension funds, the sovereign wealth funds, the major endowments sitting on the sidelines.
Because they need rules.
Institutions thrive on certainty. They can deal with strict rules, they can deal with heavy compliance costs, but they absolutely cannot deal with ambiguous rules where they might be sued retroactively. This brings us to the Clarity Act, formerly known as the Digital Asset Market Clarity Act of 2025.
The Clarity Act. This has been talked about as the holy grail the industry has been waiting for. What does it actually do functionally to solve this turf war?
Its core function is elegantly simple in theory, even if the actual market implementation is going to be incredibly complex. It officially draws a statutory line in the sand. It hands the regulation of digital commodities strictly over to the CFTC, while explicitly leaving traditional investment contracts under the purview of the SEC. It essentially removes the ambiguity of an agency trying to regulate by enforcement.
Yeah.
Suing companies one by one to set precedents, and replaces it with clear congressional statutory definitions.
But it's stalled, right? Let's look at the timeline, because the pacing here is maddening for the industry. This bill actually passed the House of Representatives back in July 2025 with incredibly strong bipartisan support. It was 294 to 134.
Getting that kind of bipartisan consensus is incredibly rare in today's political climate.
Oh, totally. But since then, it's just been sitting there, totally stalled in the Senate following a January 2025 markup session.
It is stalled legislatively, yes, but the momentum is building behind the scenes in a very real way. Former President Trump is actively urging progress on the legislation, viewing it strictly as a matter of national economic competitiveness.
And the CFTC is getting ready.
Yeah. Furthermore, the CFTC chair, Mike Selig, has explicitly stated on the record that his agency isn't just waiting around. They are fully prepared, staffed, and ready to implement the legislation immediately during Trump's term. The stated geopolitical goal is to ensure the U.S. maintains its leadership in global financial innovation, rather than ceding that capital and talent to jurisdictions in Europe or Asia with clearer rulebooks.
Okay, let's unpack this with a specific case study. Talking about bills and markup sessions can get dry, but the real-world impact involves billions of dollars of wealth creation or destruction. So let's talk about XRP.
XRP is arguably the perfect stress test for the Clarity Act. For years, XRP has existed in a state of agonizing legal purgatory due to SEC enforcement actions questioning whether it's an unregistered security.
Right.
Under the newly proposed framework of the Clarity Act, XRP could finally officially be classified as a digital commodity.
And let's be clear about what that means for you listening. If it's a digital commodity regulated by the CFTC, that legal limbo instantly ends. That means major Tier 1 banks and traditional financial institutions could finally integrate XRP into their cross-border payment systems without the paralyzing fear of SEC retaliation.
It unlocks the actual utility the network was built for.
But as always in this space, there's a massive catch.
There is, and what's fascinating here is Section 205 of the Act. The legislation doesn't just hand out the digital commodity label freely to any token that asks for it. To be governed by the CFTC, a network must qualify as a mature blockchain system. And the bill outlines strict mathematical governance thresholds to achieve that maturity status.
And the big one is the cap.
Yes, the most critical controversial threshold is a hard 20% cap on centralized holdings.
A 20% cap. This is where the math becomes a massive, potentially existential problem for Ripple, the company behind XRP. Right now, Ripple holds roughly 34% of the total global XRP supply locked in cryptographic escrow.
Exactly. 34% is vastly higher than the 20% absolute limit dictated by Section 205 of the Clarity Act. This raises an incredibly important question that the broader market really hasn't fully priced in yet. If the Clarity Act passes tomorrow, what exactly does Ripple do with that excess supply?
It's a multi-billion-dollar dilemma. Let's game this out for a second. Let's say the bill passes. Will Ripple be forced to burn billions of dollars worth of XRP to get under the 20% limit? Will they have to divest it? Can they radically restructure the escrow into blind trusts to meet this new legal threshold?
It's the ultimate double-edged sword. If they are forced to flood the open market to divest that 14% excess supply, the sheer selling pressure crushes the price.
Yeah.
Retail investors would be devastated.
Yeah, it would tank.
But if they algorithmically burn it, permanently destroying those tokens, the sudden massive supply shock could send the price skyrocketing.
So the regulatory clarity that everyone in the XRP community has been begging for years might actually trigger the most violently volatile event in XRP's history. It's ironic.
It is highly ironic. And that looming regulatory uncertainty, combined with the geopolitical macro fears we just discussed, is exactly why the institutional capital we mentioned earlier is moving so strategically and so quietly. Which brings us perfectly to our third major area of focus.
Right, the whales.
Yes, while retail investors are completely paralyzed by the Middle East conflict and the Senate gridlock, the largest players in the space are executing a radically different playbook.
This is the contradiction that blows my mind, and it's the core of the paradox we open the show with. If you're looking at your portfolio right now, you probably feel this. You look at the retail sentiment index, and it is deeply entrenched in extreme fear, hovering at a painfully low score of 23.
23 is bleak.
It really is. Retail investors are looking at Polymarket, betting on a crash. They're looking at the evening news showing missile strikes, and they are terrified. Their instinct is to hit sell and move to cash. But if you look at the on-chain data, the actual immutable public ledger of who is buying and selling at a wallet level, it tells a story of absolute unwavering confidence.
We, in the analytics space, call this the quiet accumulation. The data clearly shows that super whales, and just to define that, we're talking about individual wallet addresses holding over 10,000 Bitcoin in Bitcoin. They are aggressively buying into this retail fear.
Just scooping it up.
Exactly. Over just the last 30 days, amidst all this chaos, these massive entities have accumulated 152,000 Bitcoin.
Wait, let me do the math on that. At roughly $70,000 a coin, that's over $10 billion of buying pressure in a single month.
Correct. To put that in historical perspective, that brings total whale holdings to 3.2 million Bitcoin, which is the highest concentration of wealth in these massive wallets since 2024. They are devouring the supply.
152,000 Bitcoin in 30 days. While the average retail investor is selling at a loss out of fear, the billionaires and the institutions are scooping it up at a massive discount. And they aren't keeping it on exchanges to day trade either. We just saw 13,500 Bitcoin leave Binance, one of the world's largest, most liquid exchanges, heading straight for cold storage.
And we need to explain why that matters. That massive outflow is the ultimate signal of long-term intent. When you leave your assets on an exchange, they are liquid. You can sell them in seconds.
Yeah.
But when a whale moves assets off an exchange and into a hardware wallet or an institutional cold custody solution, you are indicating to the market that you have absolutely no intention of selling in the near future.
You're locking it up.
You are taking that supply permanently off the liquid market. It creates a supply-side crunch. But what's truly structural here is that it's not just anonymous whales anymore. The corporate sector is becoming a massive proxy for Bitcoin accumulation.
Here's where corporate strategy gets wild. Publicly traded companies are essentially transforming themselves into Bitcoin holding vehicles. Look at Strategy Inc., which most of the market historically knew as MicroStrategy. They now hold over 717,000 Bitcoin on their corporate balance sheet.
It's an unprecedented treasury strategy. And what's brilliant is how they've engineered it. They haven't just bought it with cash flow. They have structured their convertible debt in such a way that they are incredibly resilient to price shocks.
Right.
Their internal modeling claims they could weather a Bitcoin price drop all the way down to roughly $8,000 and still comfortably cover their debt obligations. They have essentially built an impenetrable financial fortress around their Bitcoin treasury.
They're borrowing at incredibly low interest rates to buy an asset that historically appreciates rapidly. But they aren't the only ones evolving their corporate playbooks. The actual Bitcoin miners, the companies securing the network, are rewriting their entire business models. Take Murray Holdings. That's a great example.
Historically, the business model of a miner was simple. You mine Bitcoin, and you immediately sell it on the open market to cover your massive electricity bills and hardware depreciation costs. But NRA just changed their corporate treasury policy to allow selling Bitcoin directly from their balance sheet, acting much more like an active asset manager than just a raw materials producer.
And then you have companies like Applied Digital who are blurring the lines entirely between crypto infrastructure and the broader tech boom. They just secured a staggering $2.15 billion bond.
A $2 billion bond?
Yeah, but they aren't using that capital just to plug in more Bitcoin miners. They're using it to build a massive artificial intelligence data center campus in North Dakota, specifically tailored for Oracle.
Wait, but isn't that a massive risk? They're a crypto mining company taking out a $2 billion bond to build an AI center. What if the AI bubble pops? How does that actually secure their core business? It sounds like a distraction.
It sounds like a distraction until you understand what a mining company actually is. At its core, a Bitcoin miner is an expert in acquiring cheap energy, building massive cooling infrastructure, and managing high-performance computing at scale.
Oh, wow.
They are leveraging that exact expertise which they perfected through Bitcoin mining to pivot into the booming, margin-rich AI infrastructure space. They are monetizing their power contracts.
Ah, I see. It's an infrastructure play. Meanwhile, Eric Trump's American Bitcoin mining company is taking the exact opposite approach, stubbornly doubling down on the core protocol. They just bought 11,298 brand new ASIC miners, expanding their network hash rate capacity by 12%, and they are currently holding over 6,500 Bitcoin on their books.
They aren't pivoting to AI. They are betting the house on the network's long-term value.
Exactly.
And this accumulation trend extends far beyond the corporate boardroom into actual state governance, which is a monumental macro shift. The state of Texas has just legally established a standalone strategic crypto reserve.
Let me emphasize this for you listening. It is not a pilot program or a small experiment.
No, they are legally mandated to purchase $10 million in Bitcoin to act as a permanent hedge against inflation for the state's treasury.
When a sovereign state entity begins legally mandated accumulation, it completely changes the risk profile of the asset class globally. It legitimizes it at the state level. And Wall Street is hungrier than ever to capitalize on this. ARK Invest just aggressively bought the recent dip we saw from the Middle East news, scooping up 22,452 shares of Coinbase for $4 million and over 158,000 shares of Robinhood for $12 million.
They aren't just buying the asset, they are buying the very infrastructure of the crypto market.
Meanwhile, the traditional spot ETFs, the regulated products that traditional investors can buy right in their standard brokerage accounts, pulled in $1.45 billion in just 5 days last week.
That is the boomer bid in action. Traditional finance is steadily dollar-cost averaging into the asset class, completely ignoring the short-term geopolitical noise that's terrifying retail traders. The financial advisors are allocating maybe 1 or 2% of their clients' traditional portfolios, but at the scale of global wealth, that 1% represents billions and billions of dollars of relentless, price-agnostic buying pressure.
Okay, let's unpack this and bring it all together. We have kinetic war driving inflation fears. We have Washington locked in a legislative stalemate over the Clarity Act, and we have massive whales and nation-states buying everything in sight. This brings us perfectly to our fourth section,
The technical masterclass.
Exactly, because to really understand why Polymarket gives a 62% probability of a crash to 50,000 while whales are simultaneously buying for a moonshot, we have to look past the news and look directly at the charts.
Technical analysis gets a bad reputation sometimes, but at its core, it is essentially the study of mass market psychology expressed through pure mathematics. And right now, the math is incredibly conflicted.
Paint the picture for us.
Let's break down the current market structure. Bitcoin is currently trapped in a very well-defined multi-month consolidation range. Imagine a box drawn on a chart. The ceiling, the upper boundary of this box where sellers always step in, sits right between $70,000 and $72,000. The floor, the lower boundary where buyers step in, is between $60,000 and $62,500.
So it's just endlessly bouncing back and forth in that box. But why is the broader technical community so bearish? If we are at 72,000 right now, aggressively testing the very top of that box, shouldn't people be euphoric? Shouldn't a breakout be imminent?
If we connect this to the bigger picture of moving averages, you see exactly why the analysts are cautious. Specifically, look at the 200-day exponential moving average, the EMA. Now, the EMA places a greater weight and significance on the most recent data points compared to a simple moving average. It reacts faster to price changes.
Okay.
Currently, the 200-day EMA is sitting way up at $90,000.
And why does that specific line matter so much? Because the 200-day EMA is widely considered by institutional traders as the ultimate dividing line between a macro bull market and a macro bear market. Because Bitcoin is trading at roughly 72,000, which is 27% below this crucial line, strict technical analysts do not view this current upward move as the start of a new bull run.
I see.
They view it purely as a bounce within a larger downtrend.
It's a dead cat bounce, just playing out over a much longer time frame. So the logic is, until we cross back over that $90,000 line and flip it to support, the gravitational pull of the entire market is still downward.
Exactly.
And if we hit that floor, if that $60,000 support level breaks, there's virtually no structural safety net until we hit the August 2024 lows of 50,000. That perfectly explains the polymarket odds. The chart guys are betting on gravity.
They are.
But wait, earlier you mentioned that whales are aggressively accumulating. How do we see that accumulation on the charts if the price is stuck in a heavy downtrend? Shouldn't buying push the price up? This is where we have to look much deeper than just the daily closing price. To see what the smart money is doing, we have to compare two vital but very different volume indicators.
Let's get into the weeds here.
We have OBV, which stands for on balance volume, and the AD line, which is accumulation distribution.
Okay, explain these terms simply for you, the listener, because this is where the real actionable edge is found in trading. This is the difference between reading the tape and just guessing.
Let's start with OBV, on balance volume. OBV is a binary, somewhat blunt instrument for measuring buying and selling pressure. It only looks at the final closing price of the day. If the day closes green, even by one single penny above the open, OBV takes the entire trading volume of that entire day and counts it as positive buying pressure. If the day closes red, it counts all the volume as negative selling pressure.
Okay, so it's exactly like looking at the final score of a basketball game. It tells you who won the game, but it tells you absolutely nothing about how the game was actually played, who led the whole time, or if there was a last-second buzzer beater.
That's a perfect analogy. And right now, the OBV line for Bitcoin is falling steeply. If you just look at OBV, it looks terrible. It looks like a massive exodus of capital leaving the asset.
But the AD line is different.
Very different. The AD line, accumulation and distribution, tells a completely different, much more nuanced story. AD looks inside the daily candle. It doesn't just care if the day was overall red or green. It cares where the price closed relative to its high and low for that specific day.
Break that down. So if the price drops heavily all day because retail is panic selling the Middle East news, but suddenly shoots up right before the market closes, AD captures that last-minute buying.
Precisely. It weighs the close against the total range. And here is the aha moment of the entire technical setup right now. While OBV is crashing, making the market look incredibly weak, the AD line is flat, and in several key time frames, it is actually rising.
So what does this all mean for the price? It means that even on days when Bitcoin is getting absolutely hammered, when the news is bad, when the daily candle is bleeding, and when the day officially closes in, the red whales are stepping in at the last possible minute.
They are putting in massive buy orders.
They are soaking up all the panic selling from retail traders and pushing the closing price back up into the upper half of the daily range.
It is the ultimate mathematical footprint of quiet accumulation by smart money. They are deliberately buying the asset without spiking the price, absorbing the selling pressure like a giant sponge. They want to accumulate as much supply as possible at these discounted prices before the inevitable breakout occurs.
But I want to make it very clear for you listening. This quiet accumulation is strictly a Bitcoin phenomenon right now. The rest of the crypto market, the altcoins, are bleeding out in a truly brutal fashion. We are seeing 38% of all altcoins currently trading near their cycle all-time lows. To put that in perspective, this pullback in the altcoin market is statistically worse than the collapse we saw after the FTX exchange imploded back in 2022.
The capital flight to safety within the digital asset ecosystem is profound. Investors are desperately selling their smaller, riskier, high-beta tokens and either moving to cash or consolidating their remaining capital into Bitcoin.
It's a flight to quality.
It's a classic flight to quality,
Yeah.
which further suppresses altcoin prices while keeping Bitcoin relatively buoyant in its consolidation range, allowing those whales to keep accumulating.
So we have the polymarket crowd betting on 50,000 and the whales accumulating for a massive breakout. Where do the biggest institutions in the world see the price going by the end of 2026 or 2027? Let's round up the forecasts, because the divergence between the smartest people in the room is wild.
The institutional models are entirely dependent on their underlying macro assumptions regarding inflation and rate cuts. Professor Carol Alexander, a highly respected quantitative analyst, predicts a wide, highly volatile range between $75,000 and $150,000, reflecting the geopolitical uncertainty.
Okay, what about Henrik Zeberg?
Macroeconomist Henrik Zeberg is targeting a slightly tighter band of $110,000 to $150,000.
CoinShares, the massive European asset manager, is looking at $120,000 to $170,000 for the second half of the year, assuming rate cuts eventually materialize.
And then you have the major Wall Street banks.
Yeah.
JP Morgan is utilizing a fascinating volatility-adjusted gold model. They aren't just guessing. They're calculating what Bitcoin's market cap would have to be if it were to match gold's exact volatility profile within traditional institutional portfolios.
And what does the math say?
That specific mathematical model spits out a target of $170,000.
And finally, Fundstrat always, the permabulls of Wall Street, they are remaining wildly optimistic, dismissing the macro headwinds entirely with a target of over $400,000. So you have a spread ranging from a $50,000 crash to a $400,000 super cycle. For you listening, what is the takeaway? How do you navigate a spread that massive?
Your primary actionable takeaway is to mark your calendar for March 18th.
March 18th.
That is the date of the next Federal Reserve interest rate decision.
Yeah.
All of these models, JP Morgan, CoinShares, Henrik Zeberg, and even the prediction markets, hinge entirely on global liquidity. The Fed's guidance on March 18th regarding inflation data and future rate cuts will be the immediate binary catalyst that decides which of these wildly divergent models proves correct.
It's the moment of truth.
It will determine in an instant if the whales were right to accumulate quietly or if the polymarket bettors were right to predict a crash.
Okay, let's synthesize this incredibly complex deep dive. We are looking at an asset class that is caught in arguably the most severe tug-of-war in its entire history. On the left side of the rope, pulling downward, you have the macro bears. Geopolitical kinetic war in the Middle East, the very real threat of $100 oil driving inflation, the reality of delayed Fed rate cuts, and a strong, yield-bearing U.S. dollar crushing risk assets.
And on the right side of the rope, pulling upward, you have the structural bulls. Massive, quiet whale accumulation, highly visible in the AD line. Billions of dollars in relentless ETF inflows from traditional finance, corporate treasuries hoarding supply to protect their balance sheets, and the impending legislative clarity that the Clarity Act could provide, potentially unliking institutional adoption for utility assets like XRP.
It is the ultimate financial standoff. But before we go, we want to leave you with a brand new concept to ponder, because this changes everything. We have spent this entire deep dive talking about how human beings, retail investors, government regulators, Wall Street bankers, panic-stricken day traders are viewing Bitcoin. We look at the charts, we feel extreme fear, we feel greed. But what if the future of this asset isn't entirely decided by human emotion anymore?
This raises an incredibly important question, and it stems from a profound recent study published by the BPI. They ran extensive, complex Monte Carlo simulations of long-term global financial scenarios, But instead of using human analysts to pick the portfolios, they used advanced autonomous artificial intelligence models.
This is where it gets crazy.
They tasked the AI to build resilient portfolios designed to survive various economic crises, severe inflation spikes, and get at geopolitical shocks.
Here's where it gets mind-blowing. In these simulated, chaotic financial scenarios, the artificial intelligence models chose Bitcoin as their preferred store of value, an astonishing 79% of the time. The AI didn't care about the news cycle. It didn't feel panic when oil prices spiked.
It has no emotion.
Exactly. It simply looked at the cold, hard mathematics of a decentralized network with a cryptographically hard-capped supply of 21 million units, and it mathematically determined it was the absolute optimal defensive asset.
What's fascinating here is the implication for our future market structure. We are rapidly moving toward a world where AI agents will become increasingly autonomous participants in the global financial system. They won't just be advising humans. They will execute trades, manage corporate treasuries, and dynamically hedge risk without any human intervention.
So, here's the provocative final thought we want you to mull over as you go about your day, look at your portfolio, or read the headlines. As these autonomous AI agents come online over the next decade and begin managing billions, if not trillions, in capital, what happens to the price of a scarce 21 million capped digital asset when the algorithms cold, calculating, and completely immune to human fear decide it is the absolute safest place to store value during global chaos? What happens to the charts when the machines, not just the humans, start quietly accumulating?
It introduces an entirely new, relentless vector of demand that absolutely no traditional macroeconomic model currently accounts for. It isn't just a new narrative. It is a fundamental paradigm shift in how we will define value, scarcity, and safety in the digital age.
Thank you for joining us on this deep dive. The markets are incredibly noisy right now, but the data always tells a story if you know exactly where to look. Keep asking the hard questions, keep pushing back on the surface-level headlines, and remember that in moments of extreme volatility, clarity is your greatest asset. We'll see you next time.